The $56 billion boat market just exploded, and it's way worse than anyone expected. Prices are collapsing overnight, dealers defaulting, lenders freezing credit, and auctions flooded with unsold boats. Even luxury cruisers and safe models are losing 30% in weeks. This isn't a slowdown, it's a total wipeout. If you own a boat or were thinking of buying one, this affects you right now, because the biggest market crash in boating history has already started, and it's spreading fast. The 56 billion bluff. Dealers are slashing tens of thousands off brand new boats, and not because they want to. A $200,000 cruiser is now being listed for $158,000, and still, no buyers are showing up. Last year, this same industry bragged about breaking the $56 billion mark in revenue, record sales, record wait lists, record profits. But the truth hiding behind those headlines was simple. The boom was built on borrowed money and borrowed time. Cheap financing and pandemic boredom inflated demand into a bubble that could never last. Manufacturers mistook temporary demand for permanent growth, churning out hulls faster than marinas could store them. Dealers filled their lots with high-priced inventory, convinced the waiting lists would never end. Now, those same boats are sitting untouched for 6 months at a time, and every unsold vessel burns a hole in the dealer's pocket. You can see it in the listings. Week by week, prices tick lower. The question isn't whether sales slowed, it's how far they'll sink before the next liquidation wave hits. The signs were already there, but few noticed the shift from scarcity to surplus until it was too late. From shortage to surplus. During 2021, you couldn't find a new outboard or pontoon for love or money. Dealers were taking deposits a year in advance. Then the world reopened, interest rates climbed, and that backlog turned into a warehouse problem. According to the National Marine Manufacturers Association, powerboat sales fell by more than 12% last year, with inventory levels up by nearly a third. That's not a slowdown, that's a stall. Behind closed doors, manufacturers started quietly paying for storage. Yard space that once turned inventory in 30 days now sits full for 120. Marinas are charging premium rates to hold unsold boats. And those storage fees are eating dealer profits faster than the discounts they're forced to offer. Some dealers are parking boats in overflow lots miles from water just to get them off the books. For buyers, it means one thing. Every week you wait, the price pressure builds. But for the businesses holding those loans, waiting costs real money. That storage problem is just the surface. The real bleed happens on the financing side. The invisible bill that comes due every single night. If you've already spotted signs of this collapse where you live, dropping prices, empty marinas, or dealers begging for buyers, drop a comment below. And if you want this truth to spread faster, hit that like button right now. Floor plan bleed. Here's what most buyers never see. Every new boat on a dealer's lot is financed, not owned. It's called a floor plan loan, and it's how dealerships fund their inventory. Each unsold unit carries daily interest until it sells. Take an example. A $150,000 cabin cruiser costs roughly $43 in interest per day. That's nearly $1,300 a month to let it sit still. Multiply that across 40 or 50 unsold boats, and a single dealer can bleed $50,000 before the next shipment even lands. Those carrying costs are why you're seeing price drops that make no sense on paper. It's not generosity, it's survival math. Dealers would rather lose 10 grand on a sale than lose it drip by drip in interest. You can spot the desperation in their ads. 0% financing, free winter storage, we'll pay your insurance. Each one is a sign of inventory pressure. For you, it's leverage, proof that the buyer's market is finally here. But even as prices fall, something else is cracking. The trust that keeps older buyers spending. Buyer trust breaks. The generation that kept this market alive, the retirees, veterans, and lifelong boat owners, can smell trouble before the headlines hit. They know when a deal is really a distress signal. Over the past few months, many have pulled deposits or walked away from new orders altogether. They're seeing discounts that feel too good to be safe, and marinas that used to have waiting lists now offering slips at half-season rates. In Florida, entire docks sit quiet on weekends that once sounded like festivals. That silence tells you everything. Buyers don't trust the pricing, and they don't trust the financing. When confidence collapses, no rebate fixes it. Dealers can repaint, restock, and rebrand, but the old rule still stands. Once the cautious buyers step back, recovery takes years. For anyone watching this unfold, patience is profit. Hold cash, wait 30 days, and you'll see which brands start flashing urgent sale banners next. But the real hit isn't inventory. It's financing. And what's happening in those loan offices will decide who survives the rest of this crash. Rate shock reality. If you thought the inventory crisis was bad, wait until you see what's happening with the money that moves it. A year ago, you could finance a new pontoon at just over 5%. Today, lenders are quoting 9.3 and in some cases over 10. That jump adds hundreds to every monthly payment. A $60,000 boat that cost $900 a month now runs closer to $1,300. Same boat, same buyer, very different math. And the banks aren't apologizing. They're tightening the screws even further. A leaked rate sheet from a major marine lender shows exactly why dealers are panicking. Their promotional financing, the kind that fueled the 2020 boom, has been quietly pulled. No 0% teaser rates. No deferred payments. Just hard math and shorter terms. Every buyer paying more means fewer buyers at all. If you're thinking of signing loan papers this month, don't. Rates are still rising, and dealers know it. The real discounts won't land until lenders start loosening again. But higher interest isn't the only wall. Even qualified buyers are getting turned away for reasons that make no sense on paper. Approval drought. Right now, lenders are rejecting buyers they would have begged for 2 years ago. Even applicants with solid credit are being denied because the collateral, the boat itself, is worth less than the loan. Marine lending used to allow loans up to 90% of a boat's value. Now, many banks are capping it at 75 or 80. That shift alone shuts out thousands of buyers. And when banks pull back, the entire market stalls. According to a dealer bulletin shared with the Marine Retailers Association, approval rates have fallen from nearly 85% in 2021 to barely 60% today. Some lenders have paused marine loans completely, labeling the segment unstable. What that means for you is simple. Even if your credit is perfect, the lender might not trust the market enough to back you. It's not about you. It's about their risk exposure. Until boat values stabilize, cash is king. And anyone who financed last year on the old rules is about to see why. Because when loans get harder to find, repos start piling up. And that's exactly what's flooding the market now. Repo row. Across the country, repossession lots are overflowing with boats that were financed during the peak. Lenders call it portfolio correction. Buyers call it surrender. Repos are up nearly 30% year over year, and everyone that hits an auction pushes prices lower for everyone else. Dealers are quietly attending these auctions, buying back the same models they sold months ago at half the original price. That's how brutal the correction has become. A repo operator in Texas told a trade reporter, "We're hauling 3 boats a day, sometimes 4. Half of them are less than 2 years old." The ripple effect is obvious. Wholesale values have dropped between 15 and 20% since last summer. That means the used boat you thought was worth 70 grand might bring 55 on trade. For sellers, it's financial quicksand. For buyers with cash, it's opportunity, but a dangerous one. Because when repos surge, insurance and resale values start collapsing next, and that's where the real pain shows up. And no one feels that pain harder than the owner who owes more than his boat will ever sell for again. Negative equity trap. Meet one of those owners. We'll call him Steve. He financed a $90,000 wake boat in 2022 with a small down payment, thinking resale values would hold. Today, that boat's market value is about $65,000. $25,000 gone in under 2 seasons. He called his insurance company to ask what would happen if it were totaled. The adjuster told him the payout would match market value, not the loan balance. That's a $15,000 gap even after coverage. This is what negative equity looks like in real numbers. It's not theory. It's a math problem that keeps growing. If you owe more than your boat is worth, selling doesn't fix it, and refinancing only resets the trap. The smart move is to calculate your break-even point now. Add your payoff balance, subtract current market value, and decide whether to wait or pay down the difference. Many lenders will let you make principal-only payments to close the gap faster. The worst move is pretending the numbers will recover on their own. Because they won't, not in this cycle. And that's exactly why Part 3 matters. When the factories start cutting back, the financial pain moves from the dealers to the docks. Production pullback. The slowdown that started on dealer lots has now reached the factory floor. Brunswick, the largest boat manufacturer in America, recently told investors it's reducing output by nearly 20% for the rest of the year. MarineMax, one of the country's biggest retail networks, confirmed in its latest earnings call that wholesale shipments have dropped double digits since last spring. Smaller builders in the Carolinas and Midwest are following suit, cutting shifts and freezing new orders. On paper, this sounds like smart strategy. Slow production, protect prices. In reality, it's the start of a ripple that kills jobs long before it restores stability. Plant managers are describing half-empty assembly lines where fiberglass molds sit untouched. Skilled workers who waited through pandemic shortages are now being sent home early. By reducing supply, manufacturers hope to drain dealer inventory and stabilize sticker prices. But every cut means fewer paychecks in factory towns that depend on this industry. When production stalls, the next domino falls. The suppliers who feed those factories. Because once the assembly lines go quiet, the companies that make the parts keeping them alive start feeling the squeeze next. Suppliers starved. When a boat builder cancels a run, it's not just the factory that loses. It's everyone in the supply chain. Engine makers, fiberglass producers, and electronics vendors all depend on predictable orders, and this downturn has shattered that rhythm. A Michigan supplier that produces resin panels for several major brands told trade media it's down 40% year over year. Another specializing in marine wiring harnesses just laid off 60 workers after 2 clients froze new production. By 2025, ownership fades and access rules. Manufacturers chase lifetime subscriptions, not one-time sales. More fees, fewer boats. Dealers become service hubs, not showrooms. It saves corporations but drains the local jobs that built this industry for generations. Manufacturers know this spiral can't continue forever, so they're rewriting their business models to survive, even if it means leaving traditional boat buyers behind. Corporate course correction. The big names are pivoting fast. Instead of chasing volume, companies like Brunswick and MarineMax are chasing predictability. They're rolling out shared fleets, subscription programs, and electric lines to create steady, recurring revenue without flooding the market with inventory. On paper, it's efficient. In practice, it reshapes who gets to own a boat at all. Shared fleets mean fewer new boats built, fewer models to choose from, and fewer entry points for the average buyer. By 2025, ownership fades and access rules. Manufacturers chase lifetime subscriptions, not one-time sales. More fees, fewer boats. Dealers become service hubs, not showrooms. It saves corporations but drains the local jobs that built this industry for generations. Those towns are where the numbers turn human, where every production cut and canceled contract becomes a family out of work. If you want proof-backed updates before the next crash hits, subscribe now. I don't do hype, just data that protects your wallet. Tap that bell, stay sharp, and don't let the next record boom catch you off guard again. Community's on the line. Drive through a boat town on a Friday morning, and you can feel the change. The parking lots outside marinas that once overflowed with trucks and trailers now sit half empty. Welding shops have help wanted signs from last summer still taped to their doors, not because they're hiring, because they never filled them before demand collapsed. In Florida, state data shows more than 3,000 marine manufacturing jobs lost since January. In the Great Lakes region, employment in watercraft transport dropped nearly 15% over the same period. Every lost paycheck hurts the town. Diners empty, hardware sales drop, tax revenue fades. It's déjà vu for retirees who built these boats. Made, bought, and financed locally, now abandoned. Factories shrink, jobs vanish, and the recovery window tightens. And while factories shrink, the rules for buyers are changing again. What's coming next decides who adapts and who gets left behind. From owning to accessing, the market has flipped from bragging about ownership to rewarding access. 2 years ago, buying meant status. Now it mostly means debt. A $50,000 used center console, financed at 9%, racks up nearly $8,000 in interest over 5 years, plus storage, insurance, and maintenance that can push the real cost above $70,000. Compare that to a boat club or seasonal rental plan. For around $400 a month, members can use multiple vessels without loans, insurance, or depreciation. The math is shifting fast. Younger buyers choose boat clubs over loans. Monthly access, no debt. Even veterans question paying interest for 12 weekends of use. Until rates drop, access beats ownership. Smart buyers wait out the storm and enjoy the water on others' dime. But while buyers adapt on their own, the industry is quietly lobbying for help. And some of those moves could tilt the next phase of prices. Policy lifelines. Behind the scenes, state agencies and trade groups are pushing emergency measures to slow the bleeding. The American Boating Association has petitioned Congress for temporary tax credits on new vessel purchases to reignite demand, while coastal states like Florida and Washington are exploring rebate programs for electric conversions and safety upgrades. None of this is about generosity. It's about keeping factories open and marinas staffed. If these proposals pass, they could inject short-term momentum into the used boat market by pulling older inventory back into circulation through trade-ins. States are offering grants to keep marine workers employed, but subsidies may lift costs instead of lowering prices. Check state sites for rebates. Buy after announcements to save. Government aid trails real discounts, so private markdowns usually come first. While lawmakers draft lifelines, some small players aren't waiting for rescue. They're quietly thriving in the cracks the big manufacturers left behind. Quiet survivors. In every downturn, there are businesses that adapt faster than the rest. Right now, it's the refurbishers, storage yards, and used parts dealers who are quietly staying afloat. When new sales stall, people repair what they already own. Rebuild shops are reporting record bookings for winter overhauls. Storage facilities are full, charging premium fees from owners unwilling to sell at a loss. And used part dealers, once an afterthought, are selling hardware faster than they can inventory it. Smart buyers watch refurb shops. When repair work slows, it signals the bottom. Owners start selling instead of fixing. That's when real deals appear. Track freshly restored listings. Those sellers need cash before the next depreciation wave hits. Timing beats guessing. Because over the next 30 days, those price signals will move quickly, and the smart money will wait for the reset before signing anything. The next 30 days. The next month decides who wins this cycle. As winter sets in, dealers face new floor plan renewals, the moment when banks reassess their inventory loans. If units don't move, lenders cut credit lines, forcing liquidation. Historically, that's when prices drop another 10 to 15% before spring. Expect steep markdowns on boats built after 2022, particularly larger models dealers can't store through winter. If you have cash, wait. Cold weather states like Michigan and New York will slash prices first as storage costs bite. Avoid loans until rates drop below 7%. Real deals appear only when floor plan extensions reset. Buy calm, not scared. Because this cycle isn't ending, it's just teaching everyone the same lesson again. In a debt-driven market, patience always wins. The $56 billion boat boom didn't just sink. It exposed how fragile the entire system really is. Dealers, lenders, and even manufacturers are scrambling, but now you know the truth. Watch the signs, protect your cash, and never rush into panic pricing. The smart money waits, then moves when others freeze. Subscribe, stay alert, and remember, in every crash, the quiet observer becomes the survivor.